Personal loans are one of the most flexible and widely used forms of consumer credit. But most people only scratch the surface of how they work. If you don't understand the details, it's easy to overpay, get trapped by fees, or damage your credit without even realizing it. In this advanced breakdown, we're going beyond the basics. We'll unpack how personal loans really work, what interest rates mean in practice, what lenders look for beyond your credit score, how to avoid common traps, and how to make smart decisions that save you thousands of dollars. Let's begin with what a personal loan actually is. At its core, a personal loan is a type of unsecured loan. That means you don't need to put up any collateral, like your house or car. You borrow a lump sum, and then you pay it back in fixed monthly installments over a specific period, usually between 1 and 7 years. Unlike credit cards, which have variable payments and open-ended terms, personal loans are predictable. You know how much you owe, how long you'll be paying, and what your monthly payment will be. But that doesn't mean they're simple. One of the biggest misunderstandings about personal loans is how interest works. There are two main ways interest can be calculated: simple interest and pre-computed interest. Most reputable lenders use simple interest, which means you're charged interest only on the outstanding principal. If you pay extra toward the loan, you reduce both the principal and the future interest. But some lenders, especially those targeting subprime borrowers, use pre-computed interest. In this model, the total interest is calculated up front and baked into your loan. Even if you repay early, you still pay most of that interest. This can be significantly more expensive over time. Next, let's talk about APR versus interest rate. Many borrowers confuse the two. The interest rate is the cost of borrowing money, but it doesn't include fees. The annual percentage rate, or APR, includes both the interest and additional costs like origination fees. Imagine you borrow $10,000 with a 10% interest rate and a 5% origination fee. That means you only receive $9,500, but you're paying interest on the full $10,000. Your APR in this case is higher than 10%, and it's the APR you should be comparing when shopping for loans, not just the interest rate. Now, let's dig into what really affects your loan terms. Most people focus on their credit score, and yes, it's important. But lenders use something called risk-based pricing. This means your rate is based on your overall risk profile, not just a number. They look at your debt-to-income ratio, which compares how much you owe to how much you earn. They assess your employment history, how long you've been working, and how stable your income is. They evaluate your credit mix, your payment history, and how you've managed different types of credit in the past. So even with a good credit score, if your income is inconsistent or you're carrying too much other debt, your rate could still be high. Now, let's talk about secured versus unsecured personal loans. While most personal loans are unsecured, some lenders offer secured options. These require collateral, like a savings account or certificate of deposit. In return, you may get a lower interest rate, but there's a big risk. If you default on a secured loan, the lender can seize your collateral. So while secured loans can be helpful for borrowers with weaker credit, they also come with greater consequences if you fall behind. One of the most common uses for personal loans is debt consolidation. That means taking out one loan to pay off several high-interest debts, usually credit cards. The goal is to simplify payments and reduce interest. But consolidation isn't always the win it seems. If you stretch your new loan over a longer term, you may pay more in total interest, even if the rate is lower. Also, if you don't change your spending habits, you could end up with a loan and new credit card debt. That's how people fall into deeper financial holes. Let's now look at fees. Personal loans often come with more than just interest. Some lenders charge origination fees, usually 1 to 8% of the loan amount. Others impose prepayment penalties, which means you get charged for paying off your loan early. There may also be late fees, insufficient funds fees, or even administrative costs baked into the repayment schedule. This is why reading the fine print matters. A loan with a slightly higher APR, but no fees could be cheaper than a loan with a low rate and high charges. Don't just focus on the headline number. You should also consider alternatives to personal loans. For example, if your goal is to pay off credit card debt, a balance transfer credit card might be better. These often come with 0% introductory APRs for a year or more. That gives you time to pay off your balance without interest. If you're disciplined, home equity loans or home equity lines of credit can offer lower rates, since they're secured by your home. But they also put your house at risk, so they're not for everyone. Credit unions often offer lower rates and more flexible terms than traditional banks, especially for people with fair credit. And if you work for a large company, your employer may offer low-cost emergency or small-dollar loans. The key takeaway here is that a personal loan isn't always the best tool. It depends on your situation and your goals. Let's now talk about credit scores. A personal loan can either help or hurt your credit, depending on how you handle it. If you make payments on time, it can boost your credit by adding positive payment history and improving your credit mix. If you use it to pay down revolving credit card debt, your credit utilization goes down, which can help your score. But if you miss payments, your score will suffer, possibly by dozens of points. And the hard inquiry from applying for the loan will cause a small, temporary drop in your score. Also, taking on a large loan increases your total debt load, which could raise your debt-to-income ratio and affect your future borrowing ability. Managing the loan properly is what makes the difference. Let's now explore strategies to repay personal loans more efficiently. One simple method is rounding up your payments. If your monthly payment is $278, pay $300. Those extra few dollars reduce the principal and lower the total interest paid. Another method is bi-weekly payments. Instead of paying once a month, pay half your monthly amount every 2 weeks. Over a year, that adds up to one extra payment without much pain. It can shave months off your loan term and reduce total interest. Also, use any unexpected money, like tax refunds or bonuses, to pay down your loan faster. And if your credit improves significantly or market interest rates drop, look into refinancing your loan to get a better rate. Discipline and small tweaks can make a big difference over time. Finally, let's talk about when not to take out a personal loan. First, avoid borrowing for luxury expenses. Using a personal loan to pay for vacations, weddings, or shopping sprees creates long-term debt for short-term pleasure. It's almost never worth it. Second, don't take a loan if your income is unstable. Missing payments can lead to fees, collection calls, and serious credit damage. Third, avoid borrowing to enable bad habits. If you're using a loan to pay for gambling, risky investments, or to keep up with unsustainable spending, it's time to fix the behavior, not borrow more. And lastly, watch out for loans with high interest rates. If a lender offers you a loan at 29% APR or higher, you're better off improving your credit first or exploring other options. A high-rate loan can become a trap. To sum up, personal loans are powerful financial tools, but only if used correctly. Understanding how they work, what costs are involved, and how they affect your credit is essential to making smart decisions. Always compare offers, understand the terms, ask about fees, and think long-term. A loan may seem like a quick fix, but with the right approach, it can also be a strategic move toward better financial health. If this breakdown helped you, don't forget to like the video, subscribe for more deep financial insights, and drop your thoughts or questions in the comments. Thanks for listening, and we'll see you in the next one.